To kick things off with the talks for today, we have our very own Deacon Demilade Obayomi, fondly called Demi. Demi is a vice president and venture capital investor at Sapphire Ventures. He focuses on investing in growth start, growth stage technology startups. Prior to his investing career, Demi was a member of the investment banking team at Goldman Sachs. Demi studied mechanical engineering at Johns Hopkins University, where he graduated with honors. He's passionate about entrepreneurship and continues to support the university's ecosystem through various initiatives such as A-Level Capital. This is an angel investment group which he co-founded. Please join me in welcoming our very own Deacon Demi Obayomi.
Awesome. Thank you so much, Ara. And it's exciting to be here with everyone. I think hopefully you can all see my screen right now. So, uh, I'm really excited to just share with us a little bit about investing and investment opportunities. And it's actually a question I know that, multiple people have, asked about in the past. So I do believe this is relevant and, hopefully we can all learn something from it. And I know there's going to be a Q&A section after like the two talks. So, feel free to just jot down your questions as we go along, and I can definitely address any questions that you have once we get through both of the talks. Um, so I'll just kind of get us started here, and we'll probably be going for the next 15 to 20 minutes overall. So I just thought it's helpful to set some biblical context. I think investing is, something we talk about a lot in the world, but, I guess as an investor, I'm very tuned to, when I see things that correlate to investing, in the Bible as well. And there are definitely many examples of this. And, really there's some outstanding investors in the Bible. So, one of the ones that I always think about, is Isaac. Isaac in the book of Genesis 26, verse 12. It says that Isaac sowed in the land and he received in the same year, a hundredfold, which anyone who is familiar with investing will know that that's an incredible return, right? It's very rare to find opportunities where you can actually, invest and in the same year, right? So not even over a multi-year period in the same year, actually receive a hundredfold. So there are these very tangible examples of investing in the Bible that we can, refer to. There's also, of course, there's the parable of the talents as well in the book of Matthew, chapter 25. And I'm just helping us maybe kind of orient ourselves, with investing and some of the examples that are there in the Bible. In the parable of the talents, the master, the owner, he's going on a journey and he gives his three servants, different talents. One gets 5 talents, one gets 2 talents, one gets 1 talent. And the one that got 5 talents, was able to turn that into another five. And the one that got 2 talents was able to turn that into another two. And this is a very classic example of investing. The only way you can do that is by, taking the resources that you have and, trading with them, and ultimately multiplying them, and, ending up with more than you originally started with. So this is another very direct example of investing that we have in the Bible. And then finally, another just phenomenal example from the story of Jesus in the book of Matthew, where Jesus took the two loaves and the two fish and the loaves of bread and was able to multiply that into something that could feed 5,000 people. This is the dream of every investor, to take something small and ultimately turn it into something large over time. And it's always exciting to see these examples in the Bible. And it's something I frequently pray about, right? It's like, look, I want to also invest and get a hundredfold, right? Because ultimately that's how you become, a legendary investor. And as Ari mentioned, in my background, I'm a professional investor. I focus on venture capital investments, which is investing in startups. And as we'll see when we get into the talk, there's so many different kinds of investing. And my goal is really to give us a bit of an overview as well as help us kind of get started a little bit as well as we think about investing. But I think it's very important to remember that we can only cover so much in this talk, and a lot of investing ultimately comes down to, people really spending time and doing their own personal research and, really finding areas of investments that resonate with them and, that they're comfortable, with given their own personal background. The other thing that's always very important to say in any talk about investing is that this is just informational. This is not personal financial advice. Everyone has a very different situation. And so, the information in this presentation may not apply directly to everyone, but just take it as informational and not as like personal financial advice for yourself. So I just thought it was important to maybe set some context when we talk about investing. Investing is just one kind of economic activity for generating income. There's a very popular book called Rich Dad's Cash Flow Quadrant. It's a book by Robert Kiyosaki, who's famous for writing a series of books about his rich dad and his poor dad. And in this particular book, Rich Dad's Cash Flow Quadrant, Robert Kiyosaki shows he shows kind of four kind of different ways of generating income, right? And one of those, the most common way that people generate income is by being an employee, right? So people have a job, they sell their time, and then they earn an income, from that job. So that's one of the most common ways of generating income. And then there's of course like self-employed people who may own their own job. So a self-employed person they could be they could, for example, be like an instrumentalist, right? We talked about this in our meeting yesterday. They could be someone who owns a restaurant, right, and operates the restaurant. They could be somebody who drives Uber, right, on a day-to-day basis. There's all kinds of. There could be somebody who runs events as like their core business. So there's all kinds of self-employed, individuals. But self-employed individuals it's still very similar to being an employee. You're spending your time and you're generating an income from your time. It's just that you work for yourself and you don't work for, someone else. And then we get into the right side of the quadrant, and the core of the book, Rich Dad's Cash Flow Quadrant, is that you want to shift from being on the left side to being on the right side, because on the left side, your ability to generate income is dependent on your time, and there's only so much time, right, that you have in a day. So your ability to generate income is capped, right, based on the amount of time that you can work. Whereas when you get to the left, when you get to the right side, on the right side, your ability to generate income has nothing to do with time, right? And so you gain leverage in the sense that you're able to generate more income, with spending less time. And there's two different ways of generating income on the right side. And one of those is the business owner. And the business owner owns a company, they own a system, they own some kind of organization. And their ability to generate income, is disconnected from their own personal time spent on that organization. So, if the CEO of Google, he still only works whatever, 40 hours a week or 80 hours a week, but Google generates billions of dollars, right, in income, right? And that's because there's thousands of other people that are working at Google as well and generating those profits, right, for the company and for the people that own a stake in the company. So that's a business owner. You can think of other relatable examples. So for example, let's say you start self-employed, and let's just say let's say you're like a wedding planner. A wedding planner is a good one. A wedding planner, if you're a solo wedding planner, then the amount of income you can generate is dependent on just your own time. Same thing if you're a lawyer, same thing if you're an accountant, the amount of income you can generate is based on how many hours you work. But as soon as you hire more people, suddenly you can generate more income than you used to without necessarily increasing your own number of hours because you're getting other people to do, more of that work. And so you transition from being self-employed and being the person, doing the work to becoming a business owner. And now you're managing other people who are doing the work and increasing, your income as a result. And then the final quadrant on the right side is the investor, right? Which is kind of where we're focusing on most of our discussion today. And in the investors quadrant, you're in the investors quadrant, now you're using money to make money, essentially. So instead of spending time, to generate income, you're taking, capital, money, assets, whatever it is that you have, and then you're putting that into business owners, typically, and ultimately generating an income stream because you own a portion, of other people's businesses. So it's another part of the income stream that we all need to, also participate in as well. Being an investor, I don't want to say it's maybe the ultimate, quadrant, because I think it's also important to own businesses and be in control of assets, but it's certainly, a part of the quadrant that is maybe a bit more accessible than owning your business. And so it's something that we can all do today. And, hopefully, this conversation will be helpful with that. And like I mentioned, as we go along, please feel free to, write down questions that we can talk about, towards the end of this program. So, so that's the cash flow quadrant. And this is a book. Rich Dad's Cash Flow Quadrant is a book. So if you're interested in the book, you can also write that down, and you can find the book afterwards as well as something to dig deeper into. All right. So when it comes to investing, um, there's so many asset classes, like I mentioned earlier. And when I introduced myself earlier, I said that I invest in venture capital, which is, an asset class where you put money into startups. Now, there are different kinds of asset classes. There's an uncountable number. This is just a very small list of the things that, people can invest in. And an asset class is just that. It's basically some type of structure in which you can put money into, and where you expect to generate a return on that money that you put into, the structure. There are different kinds of assets. Like I mentioned earlier, cash itself is an asset because you can put cash into the bank. And if you remember the parable of the talents, the lazy kind of worker, he was criticized by his boss because he didn't even put the money into the bank. So cash itself, even just money, is an asset itself. And you can actually put that money into a bank account or into different kinds of savings accounts, and that money would generate, a return, right, for you, versus just leaving it maybe in your checking account, where in the checking account, there's no return that's given to you in your checking account. So even just the basic cash itself, is a form of asset that can generate return. And then you've got this whole list, right? So there are traditional investments. Most people are familiar with the concepts of stocks and bonds. And I'll double click on those on the next slide. But there's also other kinds of investments too, like you can invest in real estate. You can invest in commodities. Commodities are things like oil. For example, you can make an investment into the price of oil, and you can profit based on whether the price of oil goes up or goes down. We can also invest in infrastructure. We can invest in art. We can invest in antiquities. We can invest in wine. Almost today, people have taken almost anything valuable, and they've been able to turn, those things into assets that people can then access, and invest in. And then we get into the world of alternative investments. These are things like, you might have heard of private equity or hedge funds or venture capital. Venture capital is what I specifically do. And typically in this world, you basically take money and you give it to people that you call managers, and those managers invest the money into businesses, startups, and so on. And the list goes on. There's almost an endless list of things that you can potentially invest in. One of the considerations in investments is something we can see at the bottom of this chart. So while there are many different kinds of asset classes, the ability to access those asset classes is is a consideration. It's not something that's easily, some asset classes are not as easily accessible as others. So for example, when it comes to cash, cash is accessible to everybody. A savings account is accessible to everybody. As long as you have a bank, you can put that money to a savings account. You can even sign up for savings accounts online as well too. So cash is maybe the most accessible type of investment because it's very easy to sign, to put that money to work, online. Stocks are also today very easily accessible because there are just so many different kinds of mobile trading apps and things of that nature. But as you get towards the bottom, of this list, now you start to see things that are not as accessible. So for example, private equity isn't something that's very accessible. Let me pause to define private equity. So um, private equity is essentially people who take, hundreds of millions or even billions of dollars, and they buy companies using that capital. And typically they do that with debt. Now, because of the amount of capital that those people invest in, it's in the hundreds of millions or billions, it's not very accessible because they're not going to go to individual people and ask them for 5,000, 10,000. They're looking for people who can, put in 10 million, 100 million, 200 million, even billions of dollars. And so a lot of times those, people in private equity will approach institutions to get that capital from them. So the point here is there are many asset classes, but asset classes vary in the level of accessibility that you have towards them. So that's one of the key things that people keep in mind as they think about where they can invest. But the good thing is as people, as your net worth increases, more and more asset classes become open to you, for you to invest. And in addition, if you're interested, you can actually go work in some of these asset classes. So like for myself, to be in venture capital, to invest in a venture capital fund, you probably want to be investing millions of dollars, but I don't have millions of dollars. However, I can go work in venture capital and be a manager and, get to experience what it's like to, deploy that capital and put it to work as well. But the main thing I want us to take away is I want to open up our eyes a bit more to see that there's so much more to investing than just, stocks and bonds. There's so many more asset classes, that are out there. And typically, these asset classes become more available to us as our net worth increases or as our capital to invest, increases as well. So I want to double click a little bit into the most common asset classes that we're familiar with. So, cash again is probably the most common asset class. And like I mentioned earlier, to invest cash is as easy as taking that money and putting the money into a savings account or putting the money into a fixed deposit account. That's very accessible to anyone that has a bank. The second, probably most accessible asset class is equities. And this equities basically refers to, stocks and, different kinds of funds that you can trade online. I think most of us are probably familiar with the concept of equity, but, just to define it a little bit more, equity basically refers to owning a share, a stake in, a business. So, in the easiest example, anybody can go online and buy a stock or buy a share of Google, and now you're an equity owner, of Google. In a more complex example, if you take what I do in venture capital, I approach business owners and I make them an offer to buy a stake in their business. Um, in pop culture, we have Shark Tank. In Shark Tank, the sharks, they sit back and then they have these people pitch them and then they make them offers to buy a stake in their business. So that's another example of equity investing. Equity investing just basically means, either the price is known and so you can just buy that, you can buy that share on the market, or you can approach a business owner and buy a portion in their business, as well. All of those are all forms of equity. It just means now you own a stake in a business. Now you own a stake in a piece of art. Now you own a stake in a building. Now you own a stake in, whatever it might be, because you've exchanged your money for some official ownership of that, business or income generating asset. And then finally, we have fixed income, which fixed income basically refers to different kinds of debt instruments. And, debt is very different from equity because, with debt, you don't own the asset. With debt, you're just a lender, to the owner of that business or to the owner of that asset. And, an easy example, right, is somebody starts a business, right? And when they start that business, I might approach them or in Shark Tank might approach the person and say, hey, I'm going to buy 20% of your business for $1 million. And so the shark gives the person $1 million, and now the shark owns 20%, of that business, while the entrepreneur, they own 80% of the business. Now the entrepreneur may need more money to, fund the business. And so now they might go to the bank, and then the bank might say, okay, yes, we're willing to loan you $1 million. Now the bank, even though they loan $1 million to the entrepreneur, they're not an owner. They're not an equity owner of that business. They're just a creditor to that business. They're just somebody who's providing, debt to that business. So that's what you have in fixed income. In fixed income, people are basically lending to businesses and they're earning interest, on that loan that they're providing to the business. And, in a simple example, you too could, loan a business money. Like you could make a personal loan to someone or to a business, and you could agree to some interest, right, rate that you charge that business, for the loan, and that's a way of generating income as well. So that's the income side of the house. And the beautiful thing about fixed income is that, you can lend to governments. There are ways of accessing, the debt instruments that governments issue, and you can actually loan from governments. You can loan to governments all the way down to individuals and small businesses as well. So that's fixed income. And then we've got real estate, which real estate is, you can split real estate up also into equity and debt. You can be an owner of a real estate, you can be an owner of a building, you can be an owner of an apartment building, you can be an owner of an office building, or you can also be a lender, right, to somebody who is going to acquire an office building, an apartment building, or anything of that, sort. So real estate is another type of investment. It's just different from like your traditional equity, in the sense that there's a physical building, there's a physical structure that backs up the investment, versus, in other asset classes, like in a business, oftentimes there might not be like a physical collateral that backs up that investment. And then finally, we have commodities, which, as I mentioned before, there are many different commodities like oil, which actually trade on, markets, and you can actually buy, you can buy like an or you can trade the price of oil essentially and own certain units, of oil, and then ultimately, as the price of oil goes up and down, you can sell that, or yeah, you can sell that or buy more of it. So, the point is, people have taken almost any asset, any kind of unit of value today, and they've made those things tradable. So I think oil is a very classic example of this, where, when you buy and sell oil, you don't actually own a portion of the oil, but somebody has just created a market around it, and now people are, essentially making bets on what's going to happen to the price of oil. So there's so many different asset classes that are accessible to us today. And I think I'm run out of time, which is shocking, but the final thing that one of the other things I wanted to mention, I'll go a bit faster because I think I'm almost out of time, is that every single asset class has something associated with it that's called the risk of the asset class. And this is a very, very important consideration in investing, is you really need to think about your risk appetite and the level of risk you're willing to take. So I like this chart because it shows, at a high level, like what are the different asset classes and where do they fall on the risk spectrum? And what does risk mean? Risk just means, the likelihood of losing money, essentially. So if you think about your, cash, if you put your cash in your checking account, the likelihood of losing that money is not zero, actually. You can lose that money, but it is extremely low. It's extremely unlikely that you will lose money that you put into the bank. Same thing with a savings account. It's extremely unlikely that you lose money that you put into your savings account. But, it's not zero risk. So, just FYI. But as you go into different asset classes, now you start to climb up the risk spectrum. Now your possibility of losing your investment starts to increase. So for example, the next asset class up there is government bonds. If you loan money to the government, it's very unlikely that you lose your money because the government is able to print money, essentially. And so it's unlikely that you actually will lose money if you loan it to the government. But if you're a shark on Shark Tank and somebody's coming to you, with a business that they're just starting, and then you're thinking of investing $1 million or whatever amount of dollars into that business, your likelihood of losing that money is extremely high. And that's a form of, you can think of that as the highest risk, right? Where you're putting money into an upcoming business, the risk of losing that money is extremely high because that business is very unproven. And so in the investing world, as you think about personal investing, it's very important to think about the likelihood of losing money and whether you're comfortable, with that risk of losing money. So when it comes to getting started with investing, the most important thing is to do your research. And the most important thing is don't invest in something you don't understand. Don't have FOMO. Don't have the fear of missing out. Don't go invest in cryptocurrencies because everybody's doing it. If you don't understand what you're invested in, then, don't put money into that thing, because that becomes the easiest way to lose money, because the financial markets are very dynamic, and, something that's going up today can very easily go to zero tomorrow. And so it's very important for us to understand, what we invest in before we put, money into that. So it's critical to do our research before we go into the world of investing. And research doesn't just mean being online and Googling. Research could also mean picking up the phone and talking to somebody who understands real estate, talking to somebody who understands, startups, talking to somebody who understands debt. So research is just a general term, but it just means, finding information that can help you make a better investment decision. So for example, I invest in technology companies. I understand technology companies, very well. But real estate, I don't understand real estate very well. So when I want to make a real estate investment, I talk to people who understand real estate and to make sure that, whatever investment I'm trying to make is something that is sound. So research is something that's critical, when it comes to making investments. Um, Whenever we think of making investments, we have to, again, evaluate various criteria. Risk is one that we talked about a few slides ago. So you have to think about, what are you comfortable with the highest risk, which is you might lose 100% of your money, or do you want to preserve all of your capital and therefore you're going to go for a safer kind of investment, even if the return, is potentially going to be lower. So risk is very important to think about. But there's also time horizon, right? Are you able to invest this money for a year, 5 years, 10 years, or is this something you can only invest for 6 months? Tax considerations, because whenever you profit on an investment, the IRS is going to come for a portion of that profit. But the tax rules are different depending on how long you hold an investment for, as well as other factors. Your budget is very important to consider as well, because different kinds of investments may have different minimums that they require for you to invest. Liquidity is a term that means, do you need access to that capital immediately, or are you willing to lock up that capital for a period of time? A very tangible example is that, if you put your money in the bank, you have immediate access to that money, right? You can withdraw that money from a savings account whenever you want. But if you go to the world of the sharks in Shark Tank, it's not easy to take your money out of a business that you've invested in. It's very difficult to access that capital, once you put it into that investment. So if you have a lot of liquidity needs because maybe you need to buy a house, maybe you're expecting a baby, maybe you're taking care of parents, then you might want to invest in things that are more liquid, meaning that it's easy to get that capital back versus things that are illiquid and are hard to get, the capital out of. Access is something I mentioned earlier. So, it's not worth thinking about private equity or certain other asset classes if you don't have the millions of dollars or whatever it takes to get access to those investment opportunities. And then finally, again, it's important to research what we are investing in. The good news that I have for us is that it's probably easier than ever to get started investing. One of my brothers just graduated from college, and I was able to talk him through different kinds of investing, and like he's able to get started with investing, even though he's just he's not even a year out of college yet. Even if you're a student in college, you can invest. If you're in high school, you can invest. Like today, investing is it's more accessible than it's ever been before. But of course, again, not everything is open. There are going to be certain types of investments are more open than others. So again, to use trivial examples, if a child has a bank account, they can be an investor because they can put the money into a savings account, right? So even a child can have some kind of investments. Once you cross a certain age, maybe it's 18 or whatever the age is, you can actually start to trade stocks, right? So more and more investments are open than they were, previously. And it's easier to get started than ever. One of the reasons why it's easier than ever is because, one, of course, we have these mobile trading apps. So I remember one day I was in San Francisco. I was walking to work, and as I was walking to work, I just bought a stock of Uber just on my commute to work. As I'm walking on the road, you're not supposed to look at your phone, but it's so easy now that you can literally buy a stock as you're walking to work, as you're sitting down somewhere. That's how easy it is now to purchase a stock. Um, Fractional shares are another factor that makes it easier than ever, because in the past, you needed to be able to buy a full share. So for example, there's a company called NVIDIA, based here in the Bay Area. They make chips or, semiconductor chips and things like that. And one stock of NVIDIA was trading for $1,000. And in the past, what that means is that you would need to have $1,000 available today to invest in NVIDIA. But with fractional shares, you can invest $1 into NVIDIA. You can invest whatever you have into the company, um, because now, like, basically the markets have innovated and it's possible to break down a share into smaller portions that people can actually purchase. So these are just some of the things that make it easier than ever for us to invest. I'm way over time, but maybe I think I have like 2 more slides. Um, I wanted to quickly highlight something called exchange traded funds, because I was thinking of what is the easiest way for someone to get started with investing. And, even myself as a professional investor, I face this challenge. There are thousands of stocks for me to invest in. And I don't have all the money in the world, so I can't invest in thousands of stocks. I also don't have all the time in the world, so I don't have time to research, thousands of stocks. So how can I actually get started, investing in a simple way, and then over time I can keep learning and get more sophisticated. And I think that's where exchange traded funds, come in. Basically, an exchange traded fund is a way where some financial people have aggregated different stocks or different bonds or whatever the case might be, and they make it possible for you to get access to all of those stocks and bonds by buying, one share. Um, Let me think of a simple example. For example, somebody may want to buy they may want to buy Apple and Google and Tesla, but they only have $10 to invest, right? So one of the ways that they can get access to that basket of stocks or more is by investing in an ETF that already holds Apple and Google and Tesla and 100 other stocks. So this is a very innovative, instrument in the financial markets that makes it possible to still access a wide number of stocks without having to put your money individually into each stock itself. And this is great. This is a great way to get started because now you don't have to think about which particular stock do I want to invest in. And you don't have to worry about how much money you have or don't have because you can get access to 10, 20, 30, hundreds of stocks, through one investment. And it's also very good because of risk. So a lot of people are naturally risk averse. Nobody wants to lose money when they make an investment. And so by investing in a basket of stocks, you're able to reduce your risk of losing money because even though one stock may go down, another one is probably going up at the same time. And so your risk is spread across, multiple stocks. So ETFs are great because they solve a lot of the issues that people run into when they think about investing. There are ETFs for all kinds of things. There are ETFs for stocks, if that's what you're interested in. There are ETFs for bonds as well, if that's what you're interested in. So it's a very nice way of accessing different kinds of assets. This is a slide that just goes more in depth into different kinds of ETFs. So, for example, there are technology ETFs, there are construction ETFs, there are biotech ETFs, there are AI ETFs. So we can find ETFs for almost any kind of industry, almost any kind of asset class. And just to wrap up, I know this is about investment opportunities, and I think it's important for us to find ways of getting started. I'm over time, and I couldn't, give us everything, but as I thought about some of the things that I do personally, I wanted us to, take away these two questions and, start to do some research. The first question I want us to, research in our own time is look into dollar cost averaging, because again, I'm thinking of how can we reduce the hurdles to investing. Many of us, we don't know what to invest in. We're worried about, picking the right stock or not. We're worried about investing too much or too little. So dollar cost averaging is a way that we can get over that hump of, the challenge, getting over the hump of deciding what to invest in and how much. So it's something I would like for us to research. And then similarly, I want us to research what are recurring investments in investing apps like Robinhood. What are recurring investments? So you can take a screenshot or write these down, and these would be good steps for you as you think about, taking action and starting to make some investments as well. So thank you so much for listening. I know I went very over time, but that's really the end of the presentation. And I'm sure there will be some time for questions afterwards, and I look forward to answering any questions that we have. Thank you.